Okay, guys, what's happening? Jay here, smarthelping.com. It's 2026. We're still building bottom up financial models. I've been working on this one for 2 solid weeks. It's for warehouse distributor or warehouse fulfillment operators. Not really buying the warehouse, but more you're operating a distribution center and earning revenue from that, and you've got costs, and you're trying to turn a profit on that type of business. It's for a single location. Um, there's a lot of stuff here. There's a lot of stuff to go through. We're on the revenue tab right now. Just to give you a quick overview of all the tabs that exist, and then I'm going to go through each tab and explain. There's a lot of calculations here, a lot of nuance. So it's going to be this will be a big video here, a lot of things to go through, and I'll try to explain my thought process in establishing these assumptions for this type of framework to produce financial statements and test different things. So first tab's global control. This will be where you just plug in high level assumptions. Then you've got the executive summary, sources and uses, monthly detail, all the way down to cash flow. Annual detail, same as monthly, but annual. Visuals, revenue tab, three matrix tabs, all the dynamic calculations, direct costs, and we have two separate ways to do direct costs: fixed overheads, capex, full-time employees, some loan options, cap table, startup cost, terminal value, income statement, balance sheet, monthly and annual cash flow statement, monthly and annual, and discounted cash flow analysis. For this type of model and operator, the discounted cash flow analysis might not be quite as relevant. You're mainly just trying to, you're probably not getting investors, or you maybe just might be raising money from friends, family, whatever, or your own money to start this thing. It's more capital light. You're going to rent out the warehouse. You might have some capex for things to fit the warehouse to what you need it to how you need it to work. Um, but in general, your main focus is revenues and expenses. And that's what we're focused on here. That's the main focus of the whole model. How are we going to make money based on what assumptions over time, and what are our direct costs? So if we start on the revenue tab, we have this top section that's going to be relevant for the entire model. And then down here, we're going to have two different options, but I'll go through that. So top section, you just define the warehouse square foot, how much of that can be used for storage. That's your essentially usable area. And then of that usable area, how much can you utilize for actual space for pallets or bins or what have you. This is for adjusting. You're going to have aisles and different space of the usable area. You can't use 100% of that for space. You got to have aisles and things. So you've got another percentage, and then you have your actual footprint area. Um, in this case, it's for pallets for the first one, but I'll go through the second way. And then you've got your ceiling height, clearance needed, and then usable height down here, which will affect the first way that we're going to define revenue. You start month for revenues, and this applies to all revenues, and direct costs will follow as well. Okay, so that's the top section, pretty straightforward. Then we get into here. So I don't know why I had this idea. I thought it was a good idea. It ended up making the model take quite a bit longer, but you now have two completely separate ways that you can produce your revenues and expenses based on different assumptions. It was extremely difficult. It took a lot of research, but basically, you can define the model according to pallet types, and we have 5 pallet types here, and everything related to that. There's also direct costs related to pallet types. Um, so you can do that route, which is this first section here. You see option 1 says pallet fees common for B2B third-party logistic warehouses. That would not be e-commerce. That's not what that is. It's the opposite. So that's this whole section right here, which I'll go through. And then option 2 If you select per cubic feet, that will shut off everything for option 1. And you can see on the monthly detail, option 1 will shut off. If you choose option 2, same with the direct costs. So that's all dynamic. But if you choose option 2, it's more of a square foot basis for e-commerce heavy operations. Uh, and I thought it's better not to try to blend them and just make something that works for everything, because they're quite a bit different in the thought process, um, just because of how they work. So we have two separate things. So pallet based or cubic feet. The cubic foot version is all down here for revenue, and that uses some of the same assumptions above, but you're basically charging per month for cubic feet. Used, you've got some occupancy stuff. I'll go through all these assumptions as I go down, but all you need to understand is you can flick these, trigger them up and down, or toggle them, and that will define the model. And you can see I put EBITDA and cash flow each year here. So as you change different assumptions, this will change. And you want to come to this model with a good understanding of your operational plan and how this works. And the more you know that, the better or the more use you'll get out of this model, because it's quite detailed. It's not something really fast, but as you use it more and do more of this, I mean, you'll be able to use it quicker. But to start off, you need to really know what your assumptions mean and how it makes sense for your scenario. So let's go through the cubic foot version first. So we start off with our revenue assumptions, which are right here. We have up to 5 pallet types, and for each type we can define how much we're going to charge for that pallet space per month. So let's say $40 a month. It means to occupy that space, and the client could have multiple spaces occupied, or customers. It's $40 per space. Now, what does a space actually take up, and how many spaces are available? Well, that's based on some assumptions here. So we have base orders per pallet per month. This is going to be derived from other calculations, which we'll get into. We have base units per order. We have average units per pallet. And the reason we have to define these assumptions is because you're also going to have revenue in relation to how active your warehouse is and how many units are going through it, how many orders you're processing, how many pallets are moving through it. All those things are dynamic and depend on your size and scale. And this model is attempting to be smart enough to change with fairly good accuracy as different high-level assumptions change and activities assumptions change. Your revenues and expenses will change in coordination with that. Column G is the percentage of footprint. So this is just saying of your total actual area that you have for pallets, 18,000 square foot in this case. This is the square foot that's applied to each of the pallet types. Now you might just have one pallet type, and that's fine. You just zero out the rest of these, and that's no problem. You don't have to use all 5, but you can. So square foot that they take up. Then we're defining units per carton and average annual inventory turns. So annual average inventory turns is how we're getting to a couple different things, mainly the base orders per pallet per month. And that's basically saying if there's 120 units on a pallet and they're doing 4 turns a year, that means the pallet is 120 units are going out 4 different times for that pallet space. And then based on the units per order, we can then derive the orders per pallet per month. So in this case, you can see we're just doing F times J, which is units per pallet times inventory turns. That's your total units you're moving through that space per year. And you're dividing by how many units are in each order times 12, because this is an annual inventory turn number, and we want to know how many orders per month exist. Now remember, this is just a base. What does that mean? Well, we have assumptions down here for orders per pallet and units per order. That's because over the course of the year, if you have seasonality, your orders per pallet So that means the amount of orders, this base is 6.67 per pallet space per month. And that'll be based on your pallet positions here. Let me put this back to pallet fees. So you got 2,600 positions here. It's saying that on average each month, 6 orders are going to go through each pallet position. Now, and then you'll have occupancy factors down here. So not all 2,600 are going to be occupied all the time. And then that base though will change. So it could be 6. It could be less than 0.75 means it's 25% less. 1.1 would be like 10% more of this base number here. So you can adjust seasonality over time, and that's going to be orders per pallet and units per order. So these two things will change over the course of a year. Now, if you just put 1, like if I put 1 for each of these, that's fine too. And it just means that your base for these are going to be the whole year. And in that case, you can see our inventory turns are 4. If we go to our matrix 1 here, you can see inventory turns are 4, which we calculate dynamically as a check. And in year 2, we also have growth assumptions for units per order and annual order growth. So that's going to apply to these base, saying that over time you might have more orders and more units per order. We can adjust the percentages here. And in that case, your turnover starts to get a little bit higher. But in the year 1, it'd be 4 if that's what you defined here. If all of these were at 1.0, meaning no change from base. Now, if they're not, if they're dynamic, which obviously, if your warehouse is seasonal, then they're going to be, then you can see this is a bit different. Here we're a little bit more than 4 because on average, well, we're starting in month 3, and then we have many months over 1 here. And now these are just arbitrary numbers. You'd put in your own factors, but that's how that's working. Okay, so again, what we're talking about here is not going to affect this monthly price whatsoever. This monthly price is just for occupied pallets or pallet spaces, but the order counts and all that will matter for pick and pack fees, which you charge. You can have a flat fee per order, also a fee per unit shipped, material or packing fee per order, and then receiving fees based on inbound pallets. And all of that is going to run off of this activity we're defining here. Okay. So moving down the line, we went through inventory turns. Cartons will be part of a direct cost assumption. I'll come back to that in a bit. But we have then, in order to know, based on we know how much square foot we have here. We know how much height there is, so we need to figure out how many pallet spaces actually are available for each pallet type. So we could say, 60% of the footprint is going to be these standard pallets, 10,800 square feet. If the pallet is 60 inches by 50 inches, that's 20 square feet that it will take up. And then if the height, including the loading height, so this is inches, is 60 inches, meaning the pallet plus whatever you're putting on the pallet is 60 inches, and then you might need to have a certain amount of inches between each pallet here. We can then derive the per level height. So that's just taking this and this and converting it to feet, so 5.5 feet. Then we're saying the total levels is rounded down, and it's just saying how much cleared space you have to go upwards against the per level height, and then we derive essentially how many levels we can go up. In this case, at 28 feet, 5.5 feet per, we can go up to 5 levels. And then we say there's floor position pallets is the footprint of the square foot, and how many, based on the length and the width here, we can fit 500 pallets, essentially 500 spaces in this 10,000 square foot area. And then based on that and going up 5 levels, we then derive our amount of actual pallet positions that we can sell. And those will then occupy a space, and you charge this amount for that space. So the model is trying to be able to allow you to put in the space assumptions of the warehouse, and then instead of just randomly thinking about how, guessing how many pallets you might be able to fit, you can actually put some math behind it and some inputs here and derive this number based on those assumptions rather than manually inputting how many pallet positions you think there are. So the model's fairly smart in that regard. So now we know, okay, how many pallet positions can we sell? And that's all of this. What's happening here, and how active they are as well. Going down, we have growth. So just annual order growth, annual units per growth, and price escalation. Price escalation applies to all of these different prices, and that's just like an inflation factor. Order growth and unit growth is just assuming, as you're operating for longer, you will be able to have more and more orders, and you're going to be more active. Your orders might have more units. So that's all that's happening here. And all those will still have to fit within the constraints that we have for pallet positions. And that's another reason why you see turnover here, basically saying, okay, based on that order growth or unit growth, by year 10, we're turning that inventory over of a given pallet position 6 times a year by year 10. Meaning, in this case, you're turning 120 units over 6 times. So that is how much volume each of these spaces are pushing through. Now there's also, well, I guess it's probably a good time to talk about it now. So you have that growth. You also have your occupancy. And then you need to know, because the model will let you, based on the seasonality in these occupancy rates, you might be putting in more occupancy than is possibly available, especially if you have a high variance and you're trying to show some months are really high, some months are really low. Well, no matter what, in a given month, you still can't exceed your maximum positions here. If you do, well, then your assumptions are not logical. So I put a check here for year 1, and you could plug in any of the year 2, 3, 4, 5 percentages into year 1 and see if you're breaching that. But in this case, based on the seasonality and the occupancy, we can see how many pallet spaces we expect to be occupied, and that's going to be driving revenue, one part of the revenue, for a given month. So seasonality, annual occupancy. Now what happens, let's say month 11, we want to say this is 12%. Okay, 2,200 slots, still good. We have 2,600 available. Say we go to 15, oh, now it's red. And it's red for all of these. Now why is that? Well, this is saying if in year 1, let's do the standard pallet, we have 60% occupancy on average. What that means is 60% times 2,500 pallets is 1,500, and then if you essentially that's your average occupancy, and then if we multiply that by 12, that's our essentially sellable spaces per year. And then the seasonality is going to define of that total that we think we're going to be occupied for. So in this case, again, 60% times your total here, and you multiply that by 12. And then you're saying in that total, essentially that's your annual expected amount of spaces you're going to sell. How much of those fit into each month? And if you put one month too high, for example here, let me format that. You have 18,000 for the year, and you're essentially saying that in year 11 or month 11, you've got 2,800 occupied pallet spaces in this scenario where 60% are your average annual occupancy, 60%, and of your total yearly, essentially, space that's occupied, 15% of it is hitting in month 11, which is November, and that's not you're now essentially selling more spaces than you have, and you can't. So you would want to either lower this. So if this goes down, that means you have now more space. So let's say it's 50% now. So your average occupancy is 1296 per month in theory, and then you times that by 12, and then you take that total against the given month again, and now you're at 2332. That's how we're getting that calculation. So at 15%, we're okay since our average occupancy rate is only 50. If this were, say, 80%, okay, now, okay, we're good for, month one, all these 7%, 8%, that's fine. But as soon as we get up, we actually can't go over 10% in a given month for seasonality. Otherwise, we're selling too much in that month. And a max, let's say this was 100, this might help you like bring it around. If you put 100% here, in theory, then you have enough to evenly spread it out each month exactly, or that's essentially your maximum. If you're 100% here, then 1/12. If you did a little bit more, let's say 8.4, you're now red. Because if it's 100% occupied, that means you're doing your total 2,600 units every single month, so every month should be even to get to that number. Now, it could be less if you had, let's say, 5%, that's fine, but you can't go over 8.3. You can have months that are less than that, but on average, we're saying that we're going to sell 2,600 positions every month of the year. You can't have, there's essentially no space to have more than that. Now, if we're at 60%, then sure, some months could be lower, some months could be higher than 8%, what have you. It just can't be more than your maximum. And the maximum, again, would be 100% occupied. So hopefully that helps. The whole point of this is just to say, here's how many spaces I have for each unit type. Here's how often on average I think they're going to be filled up during the year. And then some months might be higher than others, so I want to do an that's going to go up or down based on these percentages here. So some months could be more, and let's just say here's an average. This actually might help. Let's do 60% times 26. Okay, that's your average per month. 1555, you see this here. Let's say you still want that average, but 2% of it's going to come in the first few months, and then maybe see, you can go up higher in other months. So even though this is your average of 1555, you're lower here, you're higher here. Now on average, this is going to be some number that's probably different than this, but the point is your seasonality factor is going to work in tandem with the occupancy rate to figure out how many you're actually selling, how many spaces are actually being sold or occupied, and that will still drive your units, and all of these other things are going to be based on occupied spaces. Okay. So hopefully this table's helpful. I think if this table was not here, it would be a lot more difficult to put in the seasonality and see if it made sense or not. Okay, let me go back to how it was before I started changing everything. Okay. So we have that, which in the matrix one here for revenue, that's going to define this top section. This is your utilized space pallet spaces for each type per month. And that's doing a bunch of math with this, or formulas with this, and this number. Okay. So we got unit growth, all of that. We have revenue from the spaces we're selling. Then we have pick and pack fees. So pick and pack fees are part of, so storage revenue is based on occupied spaces times monthly price. Then we can derive our orders per pallet, our units shipped, and then based on that we can get to pick and pack fees, which is just pretty simple. How many orders did we have? Multiply that by 250 times your price escalation. Also, how many units were shipped? You've got a per unit cost here, and then again, this is how many orders were shipped, and this is an additional cost per order for materials and packing. So that's that section. So we got monthly storage revenue, pick and pack fees. Next up is receiving, which is a different section here. Receiving is going to be based on your inbound pallets, and you've got to handle those pallets. So each pallet, there's a fee here, $6, and we're calculating the inbound pallets. There's some math here. Basically, it's trying to figure out how many occupied pallets are there, how many outbound pallets were there in a month, and then based on that, you had to have we're solving for inbound pallets based on those two different numbers. So that's how many inbound pallets you have in a given month. It's not a perfect calculation, but it's pretty close. You will have months like this where your spaces go down. In that case, there's no inbound pallets. But then as soon as you have more outbound coming, now you can see inbound and outbound actually equal the same if there's no change here. It's just saying it's 1-to-1. So you had to handle basically as many pallets that went out have to come in, and there's a cost associated with that. And in this case, we're defining it based on, there's a revenue for us based on that. There's also a cost, which we get into later, but that's your receiving revenue. And then we have value-added services. So you've got relabel fees, kitting fees, return processing fees, pallet rework fees, and insert fees. So relabel fees are based on how many inbound units, percentage that require relabeling, and then the price. Kitting is per inbound units, and you divide that by the percentage that it applies to of the inbound units against how many units are in a kit, and then what are you charging per kit. And again, these all might not be relevant. Some might be, some might not be. You can zero out whatever doesn't make sense for your situation, but I was trying to be comprehensive, and for that we had to include basically everything that I could think of or find that made sense. Returns processing is going to be based on outbound units times the percentage applied against this fee per unit returned. Pallet rework fees based on how many inbound pallets there are, and saying maybe you had to rework them, adjust them based on what you're getting from the customer, and there's a cost or a price you're charging for that per inbound pallet, and then only a certain percentage of pallets will have that. And again, you can adjust these assumptions can be different for each of the 5 pallet types, which is why you see 5 different inputs here for each item. Pallet rework fees, and then per order we also have insert fees, a percentage of inserts, and what you're charging for that per order. In the matrix, that's going to be, you'll see all the math here, but here is all your value-added services. And if I zoom in here, you can see better storage revenue, pick and pack fees, receiving revenue, your value-added services. These are the 5 I just went over, all based on all these different dynamic things that we've calculated. And then we finally have total revenue for our option 1. Okay, so we've now went over all of the different revenues for pallet-based modeling, which is option 1. Before I go to option 2 and explain this, which this is a bit more more simplified, I'd say. Let's go to direct costs. So direct costs are found, the calculations are in matrix 2. So you can see here we've got direct labor, direct materials costs, and then there's like payroll taxes for those direct labor items and headcount for sanity checking based on hour capacities per um, the different labor types. But to calculate this, we have assumptions, which is where our direct costs pallets tab comes in. So this is, again, these are mutually exclusive. So if you select pallet fees as your main driver, then it's only going to use this pallet section for revenue. It's not going to do anything with the cubic foot section, and it's only going to use this direct cost section. It's not going to use the cubic foot direct cost section, which is completely different. So these, you can toggle between them easily, but they're mutually exclusive. So for direct costs for pallets, we have 8 items here. Receiving, put away, we're basically trying to define the activities that derive direct labor. We have 8 different activities. This doesn't really matter. The driver is going to help you understand, and I put notes in a lot of these boxes to try to explain the assumptions if it's not super straightforward. So receiving fees is per inbound pallet, minutes per pallet, efficiency factor, saying that the labor might not, obviously they're not spending 100% of their time working. They might have to, take breaks, downtime, just meetings, whatever. So that's your efficiency factor, which is different for each type. And then you have the average labor charges, wages of the people that are doing this activity. And it's the best way I thought to do it. So on average, what are the wages of the people that are doing the receiving? And then there's a calculation here to show how many total hours are they working on average per year, and of those hours, how many are overtime hours, and that gives you a percentage that you can then figure out a weighted average wage based on earning 1.5x for overtime. And we do a calculation here against the base wage to show what their actual average wage is. And then that will be multiplied by the number of hours that are spent doing these different activities each month. And then to get headcount, we just do the total amount per year divided by 12 against the total hours per month, and that gives us our monthly headcount. Now, for each of these, before I get into them, I've put minutes per unit, and since there's different pallet types may take different minutes to process for receiving, put away, replenishment, all these different assumptions. So you can define that by pallet, and then we do pull the weighted average here to plug into the total, which will then apply to our total amounts. So for receiving, it's per inbound pallet, 8.7 minutes per pallet. If we go to matrix 2 here, you see this calculation is taking direct cost E7 times F49, which is inbound pallets. So inbound pallets times the amount of minutes, and then we're dividing by 60, and that gets you the amount of hours per month spent doing that activity. And then we have put away, same thing per inbound pallet, different number. Replenishments, this is a little bit more tricky. So this is calculated based on the total units shipped divided by the units per pallet. Actually, I think I spent a lot of time on this one. Let's go to replenishment on here because I think I did change the calculation to make it more accurate. So what we did, the replenishment calc is taking F22, which is your orders per pallet per month, times G38. Here we go. So the percentage of orders that trigger a replenishment. Now with B2B, usually you're shipping whole pallets, so it's not often that you have to take a pallet, replenish the pallet, and then, there's not a lot of that. You're usually shipping in whole pallets for B2B stuff. So this is a lower amount, lower percentage. And then, so we're doing that percentage times the number of orders per month for the different pallet types. And then we're multiplying that by F38. And F38 is the calculated minutes for each of these, and we did it for each of the 5 types. So 8 minutes per replenishment. This amount of orders are tape replenishment. Therefore, this is the amount of, and then we, and that, so that's minutes. And then when we actually calculate replenishments, we're just taking this whole thing divided by 60 to convert it to hours. And that started off, so let me actually adjust the note here. Per calculated based on total units shipped. No, so this is actually now calculated on, I remember changing this one. There's a lot of time I spent trying to figure out the best way to do this one. So calculate based on total orders, percentage of orders needing replenish, and orders per month by type. Okay, and you can see me trying to go through each of these, heavily research how it works so that it's the model is correct in the calculations, and it was not easy and very time consuming, but I think we've got something here that's probably useful. Replenishments, picking. So this is getting the orders ready to go. It might be relevant, might not for your situation. It's just per order and the amount of minutes per order. Nothing too complex there. Packing, same thing, per order. Amount of minutes to pack per order. Outbound loading per outbound palletized unit. So this is a little bit more tricky. A palletization factor applies to outbound pallets to get the actual handling touches to apply to this minutes per event input. So here, if we go to palletized factor, we have a base amount of minutes that it takes to essentially get pallets loaded, like for loading and shipping. However, an outbound pallet in this calculation, if you go to the outbound pallets here, this is based on units. This probably spend the most time on. So you're trying to figure out units per carton or units per pallet, and based on units shipped to figure out how many outbound pallets you have. The problem is, a lot of times, an outbound pallet is going to, you're not going to have, what's the best way to describe this? These are understated. There's likely more. Because some orders might not have a full pallet. So even though we're saying, there was 414 full pallets worth of units going out, sometimes in an order, it might have not, you might have had half of a pallet used for one order, half pallet used for another order. So there's actually multiple touches that the shipping and handling people need to do. So it's more than this 414. So when you're trying to figure out what's the amount of minutes per for loading, we have this palletization factor. So let's say 1.7. All that means is for every pallet, you're actually doing 1.7 worth of touches. So palletization show that some orders only require a partial pallet, and so the total outbound pallets is multiplied by this factor. Yeah, that's it. That's exactly it. And so here you can see base units per order is only 6, and a pallet has 120 units on it. So that means even though a full pallet is 120 units and the order is only 6, so you're going to have a lot more shipping and loading events than the amount of outbound pallets total outbound pallets since that part. So there's a factor there. And again, these all will be different. My numbers are arbitrary. You'll have to go in and put in numbers based on your own research and your own uh, strategy, equipment, materials, all that is going to be different. But this is how it works so that you know how to use it. So that's palletization factor. That was a tough one. Cycle count. This is saying, you got to count the inventory once in a while to check it. You're not going to count it all every month. So this is saying that per occupied pallet slot, what percentage of the total are you counting per month? And then how many minutes does it take to count a given, we're saying it takes 2.5 minutes per occupied pallet, and then we're counting 20% of them each month to get that time. Returns processing, just return per unit returns, which is based on our actually value added service here, where we have a return processing fee per unit, percentage applied, and then that's actually going to drive our cost for that as well. So amount of minutes per return unit will be defined there, which is just based on these factors. Could be different for each one, could be the same. And then we have wage increase per year at 3%. So that's direct labor for pallets. Then there's direct materials. So here we have cartons. I have a note here, cartons used equals units shipped divided by units per carton. Okay, so that's where these units per carton comes in. And there's going to be a direct cost based on that. So we have 100% of 100% using that, and then we're just doing a division problem to figure out what's the cost per carton. And that's going to be down here, and our direct, we have boxes, cartons, it's the same thing. And we're just taking the total cartons. Cartons are just defined by what's 29 units? Yeah, units divided by units per carton, which is I-25. Yep, this input right here. So just go to check that to just make sure it's working how it should. So this is your amount of cartons, and you just add a cost per carton or box, and you're just multiplying that times D94, E94, which is the percentage applied times the amount, and then you're growing that cost by a certain percentage each year, which is defined down right here. Tape, based on cartons, cost per carton. Void fill, same thing, percentage based on cartons, cost per carton. Shipping labels, based on total orders, percentage of orders requiring shipping labels and the cost there. Return labels, based on shipped units, we're defining returns elsewhere, which you already know. Cost per returned label. Inserts, also defined elsewhere, cost per insert. Stretch wrap, based on outbound pallets. Corner boards, pretty simple, and poly bags based on units shipped and the cost per unit. So this is cost per unit shipped, cost per outbound pallet for corner boards, cost per outbound pallet for stretch wrap, cost per order per inserts, cost per shipped unit for return labels. So you can see what it's driven by, applied, and then the actual cost. Finally, we also need to account for pallet. We're accounting for pallet costs. We might be renting pallets or paying. So if we're paying for pallets, there's a couple different things here. You could be one way, warehouse supplied, meaning you're paying for the pallets. You could be renting the pallets, or it could be client owned and reused pallets, meaning no cost to you. So for each pallet type, you can define the percentage of these, what's your cost, and what's the rental transfer fee if you're renting it, and then those are also calculated right down here. Well, materials would be right for this, and then I did pallet cost right here. We'll put a bold on that. And actually, did we add pallet costs into here? Direct costs? I don't think we did actually. I need to add that. I'll do that. I'll do that out off the video, but that should be a total there for both of these. Should have pallet. No, option 2 doesn't have it. Option 1 does. So I'll have to add that. So that was working right here. I just got to add sum up these as a direct cost. Okay. So that's pallet based. That's everything with pallet based. The only other thing is we do have capex here, which this is going to apply no matter which scenario you pick, and it's just a direct cost of goods sold, and it'd be for the bins, whatever, just anything you haven't accounted for that you have to purchase that's directly related to providing your service is just defined right there. So, and that'll be depreciation expense. It's a non-cash item. It does hit up, right here. It does affect gross profit, but then it'll be added back to get the cash flow. But we do account for those. Then the other capex items here are still expenses, but they're depreciated. They're below the line essentially after EBITDA. They're included in EBIT, earnings before interest tax. But it's not included in EBITDA, earnings per interest tax, depreciation, amortization. All right, I told you this was intense. I spent so much time building this out, trying to make it make sense. So that is, and I believe it does. All right, so let's go to option 2. So we switch over here to per cubic feet. So we're going to ignore everything we just talked about. And instead, we're charging based on monthly price per cubic foot. We have seasonality here, and this seasonality is just saying in each month, what percentage of the total sellable capacity. So you have your total cubic volume, the effective volume, and then the sellable. The sellable is again based on this. You got aisles and things you got to account for, so that percentage. So that's how much space you can essentially sell, what you're selling it for, and then how much of this 500,000 is being used or occupied in each month of a given year. And then you can adjust over time. You could adjust it with these percentage up top to make, like, if it's 1, 2, whatever, or 1% improvement each year, or 2% each year, whatever it is, or maybe 5 up to year 5, and then whatever it is in year 5 will go through to year 10. That's your occupancy. So this doesn't have the constraint where you've got what we talked about before with like a average occupancy rate and seasonality factor like that. This is actually just allowing you, since it's only one thing, total space, how much of that total space is occupied in a given month, and then how does that change over time. And that'll just define times your cubic capacity times your assumptions down here to figure out what your how much throughput your warehouse is doing. So growth, order growth, unit growth, same deal, price escalation. We have assumptions here, base orders per occupied cubic foot per month. So of the occupied cubic feet, how many orders are happening per month. Base units per order, average cubic foot per unit. Then we can derive order cubic feet. Then we have to define average carton size in cubic feet. So what you're putting the stuff in e-commerce, what's the average size of the cart that you're putting your stuff in. That's going to be needed to know the effective carton capacity and the average cartons in a given order. Also, fill efficiency defines, of this total carton size, how much is actually available. And then we do that against the amount of cubic feet in a given order to figure out how many cartons we need for a given order. We have storage revenue based on the 60 cents times occupied cubic feet over time. We have pick and pack fees based on, flat fee per order, fee per unit, materials packing fee, cubic foot received, charging for that here. And that way it's a little bit different, this one, but these are pretty much the same as the other version. Value-added services, we have fees per inbound units per inbound cubic foot for rework fee, And per order, we have custom packaging. And then we also have a seasonality index here. This is going to apply to orders per cubic foot, which is, again, this one, and is defining how much volume you're doing, and units per order, how big are the orders over the course of a year. Some months might be bigger or smaller, and that will affect your units per order base here. So a little bit simpler assumptions on this one. And you can see in matrix 1, if we go down here to revenue for option 2, this is where we have all of the things I just talked about. So your occupancy rate, occupied square feet, storage revenue, how many orders you're doing, your pick and pack fees based on that activity, receiving fees based on cubic foot inbound, average units on hand, and we still can count average inventory turns based on your outbound units against your average units on hand. Average units on hand is based on, I believe, the units per square foot against the occupied square feet. So simpler calculations, but still definitely makes sense, and you could adjust them. And then all these relatable fees, kit bundling fees, similar logic, just based on these different things, just less data than the top part, because there's not 5 different types of pallets. You're just selling the entire warehouse space based on those assumptions. So that's revenue option 2. Direct cost for cubic feet. This is more complicated, and so I had to put notes in a lot of these. I don't want to go through each. Well, I guess we kind of have to. So inbound receiving per inbound units, we have an applied percentage and amount of minutes per inbound unit. Wages and efficiency factor and all that still works exactly the same as like the other option 1. Inbound extra labeling per inbound units. Extra labeling is actually a fee, added fee, so we have that based on our value add fee here. Relabeling fee, and amount of time it takes per inbound unit. Decanning, prep to pick model, all so per inbound units. Time per unit, per stock task. So put away, we're doing the number of inbound units that make up a single task. So we're saying for every 40 units there's a task, and then what's the amount of minutes for that task for this activity. So you're dividing total units by 40, multiplied by this is total minutes. And then we're dividing that by 60 on our costs here. So you can see all these costs, these are hours for all these activities I'm talking about here. Labor wages. And again, there's no pallet. That's the main difference between this and the other ones. There's no direct pallet assumptions. You do have cartons or boxes, though. So replenishments, we just have a replenishment factor, the number of outbound units that make up a task. So that divided by this times the amount of minutes. Picking per inbound unit, time per unit, per order and per unit. So this is, the packing is a little bit different. So we've got the amount of minutes an order takes, and then we also have the amount of minutes per outbound unit. So every order takes 1.2 minutes, but then we're adding an additional 0.05 minutes per unit. And then for shipping, we have parcels per order. So we're saying for every order there's 1.05 parcels, and then we're saying how many minutes per parcel is it taking to get that ready to do the shipping. Outbound cubic foot handling, we have per outbound cubic foot, the amount of time per cubic foot. We have return processing per return, amount of minutes per return. Kitting, we have similar math here. We already know what we're saying per inbound units. We're saying the amount of minutes per inbound unit, and then for cycle counting, per cubic feet, and we're saying here every essentially count every 15 minutes we can count 2,000 cubic feet. So we're doing occupied cubic feet times 25% since we're not counting all of it every month, and then that however many 15-minute slots that takes is the amount of time per month. So that's all of those. Direct materials, very similar. So per carton, cost per carton, per order, cost per order, per order, per label, per order, per poly bag, percentage that require poly bags, and then fragile percentage out of that times the cost there. These are all pretty straightforward. Inbound consumables per label, cost per label, outbound cubic foot, cost per outbound cubic foot for stretch wrap, and returns, amount of money for return supplies if that's relevant, and then the cost or price inflation. Okay, wow, I got through it. So those are the main revenues and direct expenses of everything. Fixed overheads. This is just for like rent, utilities, any fixed expenses that you're not or any expense you're not accounting for elsewhere that you want to put here that are, you've got a start month and the annualized cost amount, and then you could change the top section changes based on the percentage. The bottom is just manual, and this is your annual cost each year. We've got 3 different sections for this. Oh, sorry, my Excel froze. R&D, function of total monthly revenue here is percentage just for additional things if you haven't accounted for elsewhere. I'll zero these out. CapEx we already went through, but you put the items. This top section here down at row 20 is for direct costs. Bottom section is just for regular expenses. Cost basis, the month of purchase. Useful life will define depreciation, and months placed in service will define when the depreciation actually starts. Full-time employees, pretty simple. Start month, the count, annualized salary. You've got payroll tax and benefits up here, and annual increase. We have some loans. You could do loan draws to fund working capital. Interest rate, it can convert to a long-term loan if after the interest only period if you want. And yep, pretty straightforward. You've also got loans 2 and 3, which are standard term loans. Could be for other things, equipment, etc. 2 different loans are to define. Cap table, this is rarely going to be used, but basically based on all the assumptions, this is going to tell you how much cash you need to stay afloat. And then the total cash is going to come from outside investors or inside investors or operators, which is you. And anything that you don't fill in here that still needs to be in your short will just go into this fill overflow row. And then all you're doing is putting the percentage of the company that you're giving to each row here. Again, this percentage should add up to 100% added if you add up the top and the bottom. So and that shouldn't be 95. They'll say that's 20 and founders are 80. Okay. Other startup costs, this is just going to hit cash flow. Any other like consulting fees or anything startup costs that are not accounted for elsewhere. Terminal value probably can ignore. I usually just keep it 100%. Not that relevant for what we're doing here. Income statement, we have our revenue items, direct cost, gross profit, operating expenses, EBITDA, interest, total depreciation, EBIT. And keep in mind this gross profit does include depreciation, but in EBITDA we add it back, and then in EBIT we just take the total EBITDA less the depreciation. And you also have taxable income, net income. We have exit value we do define here as well. Income statement annual is just same thing on an annual basis. Balance sheet, all balances out. All these things adjust with the assumptions. Cash flow statement, it's kind of like your sources and uses a little bit on a monthly basis, even though we have a separate sources and uses here. Mainly going to be the initial capex and then a little bit of operational burn. It depends on the scenario. Discounted cash flow analysis, just taking the total project cash flows, and then based on that cap table, those percentages, it's going to flow one amount to investors and then the rest to the owners based on those percentages in the cap table here. Again, that stuff's probably going to be less relevant. This model is mainly going to be used for the income statement balance sheet, cash flow statement, and just the core operations, all these different assumptions, and trying to figure out what that looks like and what's feasible. Um, then we have our executive summary up top. Now these kind of things make a little bit more sense. What's going on here? Visuals, source uses, monthly detail. You see the different revenue, direct costs. I will add in the box costs for option one, the pallet costs. That'll be I'll add that in before I upload it. Annual costs or annual detail, same thing, but an annual basis. Um, Visuals, we have revenue, gross profit, and I did a little labeling that's cool up top here. Gross profit, not including depreciation, EBITDA, gross profit percentage, cash flow, headcount by activity, which will change depending on the option you pick. Let's put this back to option one. EBITDA percentage, annual revenue by type, so all your different revenue sources, main one being the pick and pack fees. EBIT, annual capex, total assets versus total liabilities, monthly cumulative cash flow. You can kind of see the seasonality there. Total assets versus total liabilities monthly. Annual units processed against EBIT per unit, so what you're earning per unit processed, and then how many units you're actually processing per year. Monthly units processed, monthly orders processed. There you can really see the seasonality, and then average units per order. All right, I believe that touches on everything, and I am excited to get this out. I've been working on this really hard for a few weeks now, and it's very unique, very operator specific, and hopefully it helps warehouse startup operators or fulfillment centers. Oh, the front you can define forecast periods. So let's say you want to do 60 months instead of 120. Oh, I'll have to adjust that. I imagine. So let me see here. I probably have to put stops in, but you can adjust the period. So if there's less months, it'll only show. It'll stop after that amount of months. You can see here, and then exit value. If you include the terminal value, just a multiple of EBITDA, and then start with the forecast is just arbitrary number to display at the top. Also will affect seasonality though. The rest of this stuff is just summaries of other areas, and then you've got income tax rate, and then your checks here will just make sure all your different summaries are matching. All right, if you want to download this, it is available at smarthelping.com over here. I will put it in the industry specific area, which obviously it'll also be included in that bundle price, but you can buy it separately. I think I'll probably charge the $99 one-time fee for this thing, and I'll put it in the I don't know if it should be in the industrial or the services. It kind of fits in the real estate bundle as well. I'll probably put it in the real estate section here, and then I'm also going to include it in this bundle, and I'll also include, if we go back to the home page, the real estate templates. We'll put it in here as a other similar templates in the real estate industry. They'll be in here. So two different places you can get it. It'll also be, if you want to check out more, go to the financial models tab at the top. I've built hundreds of unique financial model templates over the course of the decade. Industry specific, a lot of stuff in the SaaS space, real estate space, joint venture waterfalls for preferred returns, IRR hurdles, all types of things. A lot of good stuff here if you're trying to learn about anything. A lot of good stuff. General business valuation, accounting specific templates, HR management. I built a lot of stuff in Google Sheets for tracking as well. So if you want to try and get something done, I could do billable work for $275 an hour. I could also build custom templates or modify any templates you see on the website here. If you usually a client will come in if they're going to do some work, they'll probably just go if you go over the templates at the sidebar and go to the Super Smart bundle. Usually they'll purchase this and then we'll do work and I can just pull from whatever templates ever exist on the site and they don't have to download them ever. This covers all of that. So that's a common thing. Other than that, I'm excited to be done with this and push it out. I really wanted to get a new template done before February was over, and we have done that. So I'm excited. I'm gonna while you're around, you guys, if you want to watch me, I can add that cost in here. So the pallet costs, it'll just be a simple sum up total pallet costs. It's because I never bolded it and I missed it. Where is it? Right here. Because I don't believe so. Direct labor was 33 to 40. It was this. Let me just double check. Payroll taxes 102 to 109, and then direct materials is. Oh wait, did I add it? Wait, 44 to 53, 94 to 98. I don't. Oh, I did. I did. Okay, never mind. That doesn't need to be added. So I'm glad I checked that. So I'm already adding it in the direct materials and consumables. So D44 to 53. That's good to know. 44 to 53, and then 56, or sorry, not 56. 94 to 98. Yep, 94 to 98. So that's that. Payroll taxes 102 to 109. That's here. Yep, payroll taxes. And then labor is at the top. Okay, so we got both those sections. Direct materials, payroll tax, and direct labor is at the top. Okay. And then these are good. There wasn't any extra thing for option 2. Awesome. All right, I don't have to change anything. It's good to go. Um, like I said, check out smartman.com to download stuff. I'll see you guys on the next one. Like and subscribe. And I'll probably try to do one template a month. So month of March, we'll try to get something else done. All right, guys. See you later.